that the average in the S&P over a long-term period is 10%. It's not because it's 10% every year. It's because we have 20% years and then down 15. There's volatility along the way, and I think understanding your risk appetite and knowing what you can stomach in the
early
year.
25 to 30, everybody thought that, the world was over, and if you just hung in there, it ended up 20% up or better at the end of the year.
Today's episode is brought to you by Security Financial Management.
Markets have been anything but calm lately. Between rising tariffs, global uncertainties, maybe a little political posturing, all which have shaken investors' confidence. Which leads us to today's question. In such volatile times, how do you invest in the market confidently? Let's talk to the experts.
Ooh, welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here as always with Austin Fats Jacks and Frank Lavalio. Gentlemen, what's cracking this morning?
It's going good this morning. We're going into a Tuesday, into the flow.
Easter was yesterday, Sunday.
Tuesday? I don't think that's a thing.
Yeah. Easter was this week. Good Easter. You have a good Easter, Austin?
Strong Easter. Really hit the sweets very hard. Gave up sweets for Lent.
Yeah, that was hard. That was
myself
good of you.
on Sunday.
That was good of you.
Saw some neighbors' yards. It's kind of fun. We're getting more young people in the neighborhood, and they set up a cool Easter egg hunt. And I was tempted to go grab an egg. It just looked fun, and the kids were running around. I thought, you want me to participate? They didn't seem interested in me
I
jumping
Mom got me an egg.
I'll be frowned upon.
It was awesome. I got an Easter basket still.
Yeah, that feels good. Yeah.
All right, let's jump right into it. Today's question comes from Kent from Gainesville. Kent, what you got for us?
Markets continue to be volatile. What are your team's suggestions for investing in a volatile market?
Thank you, Kent. Gentlemen, who's going to jump into this one?
I think
Are you going to take this one?
We're going to let you go first today. Dan.
I think we just say that to make everybody feel good, but I always like to jump in. Well, I'm the guy with the gray hair,
Fair
I got to
enough.
go first.
I'm coming in hot.
Yeah.
I'm coming in hot.
You're still not there.
I'm speckling. I'll say that.
Yeah.
Got a little seasoning.
But we're the same age. That's not fair.
You gotta, you're coming on strong. Yeah. We'll let the gray-haired guy feel good at the beginning. And then we'll let the brains take over right off the jacket. No, I think that on a serious note, investing in volatility, it's such a appropriate topic because of all the craziness with the tariffs and the economy and again, we never get political, and we're not going to start today. There's just a lot going on, and there's a lot of political environment. You got China positioning themselves, two great powers. They're playing chess, and the market. The one thing about the market is it loves certainty, right? I mean, the market likes to know what's going to happen. And right now, if we're being honest, no one really knows what's going to happen. The tariffs are brand new territory. I mean, I see both sides of it. I mean, we are trillions and trillions and trillions of dollars in debt. You look at Greece, Argentina, Lebanon. I mean, there's great countries that have fallen because they never got their economic debt under control. So I understand sort of where we're going. Again, it feels fast. It feels volatile. So the question is volatility. So, boy, are we having it right now, right? We're right in the middle of it. And I think that from a portfolio standpoint, we always say, our firm always says, you got to build a ship before the storm comes, right? Because the storms are coming. COVID, that was out of nowhere. We're minding our own business, and someone, all of a sudden in China, people are getting sick, and then there's all these deaths, and that you better have your ship built because that's going to be a storm out of nowhere. That was feels like a long time. That was 20, it started ended in 22.
Yeah.
So think about
that. Whole year.
That's
a long time.
Right? It's 5 years, was it? I mean, it's like, so that's
and the market ended.
When did that be? It went down, 25 to 30. Everybody thought that, the world was over. And if you just hung in there, it ended up 20% up or better at the end of the year. So it's like this V-shaped recovery, that's kind of a W, isn't it? Let's go like that. V-shaped recovery, no one expected. So is the tariffs a V-shaped recovery? And nobody really knows. I mean, we got to be straight. Who knows? I mean, could it be worse? Could it be better? That's why Austin and I always say with our clients that we work with, the whole firm, but we always say there's a risk premium to be in the market. The risk premium is if you want to get 2 or 3, depending on interest rates, then just plant yourself in a CD 4, depending on the interest rate, and get 4 forever. But if inflation's 4.2, you can go broke safely getting 4% if inflation's 4.2.
Yeah.
The risk premium to the market is you got to be in it. that means minus 20, ow, but maybe up 30. So that's the deal. So back with the ship, you got to build a ship on the front side to be able to go through the storms. And what that means is understand your risk tolerance. Talk a little bit about, Austin, two things because I get kind of pumped up. Risk tolerance and then sector rotation, because those are two things you got to really understand before you go in, part of building the ship.
Absolutely. I think, to your point about, the risk premium, I mean, there's a reason that the average in the S&P over a long-term period is 10%. It's not because it's 10% every year. It's because we have 20% years and then down 15. So there's volatility along the way. And I think understanding your risk appetite and knowing what you can stomach in those given years.
Before
I like that word, risk appetite.
Yeah.
You can stomach.
Yeah.
You see that? I kind of like that. Yeah.
I need breakfast.
I didn't eat either. My stomach's growling.
But no, going back to it, so understanding what you're able to stomach is, hey, if the market's down 20, I'm okay being down maybe 10. So you're not all the way in the market. Try to weather some of that volatility. But then, on the other hand, knowing that, hey, sometimes these volatile times can really, create opportunities if you have some cash to deploy. So if you have the stomach to kind of invest, in choppy seas or whatnot, there's opportunity there. We think over the long term, but understanding your risk appetite on the front side, it is super important.
The key is just that you got to build it early and understand that's such a good point, Austin, that the risk play, because if you really risk tolerance comes to play in these markets, you can think, say on a scale of 1 to 10 to oversimplify, you think on a 10 being aggressive and 1 being hide my money under a mattress. Let's say you think you're a 7, a little bit on the growth side. You don't really know you're a 7 until right now. Because it feels 7-ish when the market's kind of doing up 6, up 7. Yeah. But then when the market goes down 20 or 10, in 2 months, it's like, am I really a 7? Then you really might be a 5. And the key to that is, again, overplaying it or oversimplifying it. Make sure the money that you do, or you maybe have half in or half out if you're really conservative. Sure. So then if the market, 50% of your money goes down 20%, if you're conservative, that feels a lot better than 80% of your money going down 20, 40, 50% on a really horrible market.
Right.
So knowing that's key. The other thing I wanted to, you talked about, because this is really big, is sector rotation. When do you do that? How do you do that? What does it mean?
And that's where the diversification play comes into focus is, which asset class should we be invested in? Forever, growth was just running hot. The tech-heavy stocks, Apple, NVIDIA, Amazon, Microsoft, all these things are running.
Mag 7 was running like crazy.
But now, some of the more blue chip names, value stocks, dividend-paying stocks are much more in favor. So kind of having it built where, hey, we've got exposure to all areas of the market. So that way, you're not, over allocated to one particular, sector, because you never know when it's going to come in and out of favor. So having exposure to all those areas, it's all part of a diversified approach. But
what was the one strategy you said?
Sector rotation.
Sector rotation.
Meaning, what does that mean?
Meaning, like I said, the tech stocks were super heavy, growth stocks were running for a while. Now they're getting crushed. Okay. So that's kind of that sector, that rotation from growth to value, dividend-paying stocks. Now dividend-paying stocks are doing better. So having exposure to both areas is prudent.
And part of building the ship, right? So we said that we started off answering the question, you got to build a ship before the storm. Well, you have to understand that sector rotation is going to happen. Yeah. I mean, 15 years ago it was value. And you know what's doing better than anything right now? International. International was for years, the U.S. has just crushed overseas. Yeah. But, I'm going to get the math wrong, but international's up a couple percent year to date. And the Mag 7's, at least at a down 10% or more. Yeah. So that's a 14% swing. That's 1,400 basis points difference. So building the sector rotation strategy before the storm hits. Don't be all growth, because all growth was hot. Maybe you're 25% growth, 25% value, 25%, cash, and 25% fixed bonds, just to be, super conservative and explain the point. Diversified asset rotation portfolio. So, because that's a big deal.
Absolutely. And that helps kind of weather some of the volatility that we're seeing too. Absolutely. Because you have exposure to all those areas. Yeah, maybe this portion of my portfolio is getting crushed. Meanwhile, I've got one that's protected, not moving much. And then, right now the international stuff is actually positive for the year. So it's, having exposure to all those asset classes, plays into, mitigating some of that risk, volatility, et cetera.
Make sure your ship is built early, number one, to summarize. Number two is make sure you understand your risk tolerance. Really understand your risk tolerance, and you really get the stomach for it when you're in the middle of storms, but do it early. And then make sure you talk to your consultant specifically. We're being general on the show, but, talking about 3 different buckets, 4 buckets for simplicity of explaining it on the show, but really zone in with your financial advisor or whoever you trust to make sure your allocation is specific to your needs, because that's really what matters. And if you don't have a financial advisor, Austin Jacks, Frank Lavaglio, we have a big team here. Call us. We'd love to help you if that makes sense for you. But I think that question was extremely well answered, Austin.
I did too, Frank.
I would agree. All right, Kent. We hope that helps. Remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.